Victor was 46 with $0 in retirement, $3,800 in cash savings, and $7,200 on a credit card charging 22.99%. He had 21 years until age 67. Victor had driven passengers around Scottsdale, Arizona, for 11 years. The system could see his card balance. It could see payment history, reported credit limits, applications, and the income documents he could produce. It could not see 11 years of safe driving, the customers who requested him again, or the business he hoped to build. That gap is the visibility tax. The visibility tax is not a government levy, and it is not a claim that closed determine a loan price. It is the financial pressure created when a decision is made from the report, score, balance, and documents a system can verify while effort, context, and future potential remain invisible. This video will show the 3 mechanisms inside that pressure and the 12-month file Victor built to make the right facts visible. Victor is a fictional composite. His income, debt, cash flow, and future balances are illustrations. The federal consumer guidance and published data are real. Victor's fictional rideshare business collects $58,000 a year in gross receipts, fuel, maintenance, commercial coverage, platform costs, cleaning, phone use, and other documented business expenses total $16,000. That leaves $42,000 of net business profit before personal taxes. For this model, Victor sets aside business costs and estimated taxes, then transfers $2,900 a month to personal checking. Actual tax obligations and spendable income vary by location, filing status, business facts, and applicable law. His personal commitments and known non-monthly costs average $2,400 a month. His reliable margin is $500. The first visibility tax mechanism is the report error toll. Credit reports are data files assembled from information supplied by other companies. Most data may be correct, but an error can become visible to a lender before Victor sees it himself. A congressionally mandated Federal Trade Commission study found that 1 in 5 consumers had an error on at least one of 3 major credit reports. This study found that 5% had errors that could lead to less favorable terms for products such as auto loans or insurance. That does not mean every error changes a score or every consumer pays more. It establishes a real failure point. If the visible file is wrong, a decision can begin with the wrong fact. The Consumer Financial Protection Bureau tells consumers to check for accounts that are not theirs, incorrect late payments, closed accounts shown as open, duplicate debts, and incorrect balances or credit limits. The correction process requires evidence. The person doing the work has to identify the item, explain why it is inaccurate, and include supporting documents. That effort is invisible until the dispute file makes it visible. The second mechanism is score compression. The CFPB explains that banks, card companies, and other businesses use credit scores to estimate how likely a borrower is to repay. A higher score can make it easier to qualify and may help a borrower receive lower rates. But there is not one universal score. Different lenders can use different formulas, products, and reporting sources. Victor can be 11 years reliable as a driver and still be compressed into a number built for a specific credit decision. The score is not his character. It is an input used by the system. Revolving interest can make that compression expensive. Victor's $7,200 card at 22.99% creates a simple monthly interest scale of about $137.94. That is $7,200 multiplied by 22.99% and divided by 12. It is not a prediction of Victor's next statement. Many issuers calculate interest daily from daily balances, and billing cycle length, fees, new charges, and payment timing can change the result. The scale shows why the visible balance can resist progress. If Victor pays $500 while interest remains near $138, only the remainder reduces principal. The system sees the balance again next month. Victor sees another month of work compressed into a smaller principal change. The third mechanism is the proof gap. An employee may receive one pay stub from one employer. Victor receives deposits from platforms, direct customer payments, tips, refunds, and reimbursements while paying expenses on different days. His work is real, but without organized records, his business story is fragmented. The Internal Revenue Service says a self-employed person's record system should clearly show income and expenses. Supporting documents can include invoices, receipts, deposit records, paid bills, canceled checks, and account statements. Good records help monitor business progress, identify receipts, track allowable expenses, prepare returns, and support items reported on a return. The IRS does not promise that organized records will produce a deduction, a loan, or an approval. The records make the facts auditable. That is how Victor begins blocking the visibility tax. Step 1 is the accuracy file. Victor requests his reports from the 3 nationwide credit reporting companies through annualcreditreport.com, the federally authorized source. He reviews identity information, account ownership, payment status, balances, limits, and duplicate entries. He does not dispute accurate negative information. He disputes only facts he believes are inaccurate or incomplete. The CFPB says correcting an error generally means contacting both the reporting company and the company that supplied the information. Victor writes what is wrong, explains why, and attaches copies of supporting records. He keeps the originals. This script does not invent 3 errors or promise a 40-point increase. The result could be a correction, no change, or a request for more evidence. The accuracy file blocks the report error told by making the dispute specific and documented. Step 2 is to stop letting the revolving balance dominate the file and the cash flow. Victor begins with $3,800 in cash. He keeps $1,500 as a personal starter reserve based on the smaller emergencies in his recent history. That is not a universal emergency fund number. He applies the remaining $2,300 to the card. The balance falls from $7,200 to $4,900. Using savings against high-interest debt carries a trade-off. Less cash is available for a larger emergency. Victor keeps the starter reserve because his income depends on a high-mileage car. Someone with unstable housing, medical risk, dependents, or a different income pattern may need a different reserve before making an extra debt payment. Investor.gov says eliminating high-interest car debt generally offers a benefit that investments are unlikely to match with equal certainty. Victor then pays $500 a month. The model assumes no new charges, a constant 22.99% annual percentage rate, monthly compounding, and payments at the end of each month. The first modeled month after the cash payment adds about $93.88 of interest to the $4,900 balance. Under those assumptions, the card reaches zero in month 11. The final modeled payment is about $479.13. Total modeled interest after the initial cash payment is about $579.13. About $20.87 of the month 11 margin remains. In month 12, the released $500 moves to the reserve. Victor ends the modeled year with zero car debt and approximately $2,020.87 in cash. His starting net position was negative $3,400, $3,800 in cash minus $7,200 in debt. His month 12 net position is approximately positive $2,020.87. The modeled improvement is approximately $5,420.87. It is not a tax refund or investment return. It is the result of cash flow contributions, principal reduction, and an explicit reserve choice. Step 3 is the proof file. Victor uses one business checking account for rideshare receipts and business expenses. Each month he records gross receipts, platform fees, fuel, maintenance, insurance, phone allocation, and other supported business costs. He keeps receipts and mileage records and produces a simple monthly profit and loss statement. He maintains a separate tax set-aside. An organized file does not make income larger. It makes the existing income and costs easier to verify, monitor, and explain. The proof file blocks the proof gap. Step 4 is to convert a credit decision into specific information. If Victor is denied credit, the CFPB says the lender generally must provide the main reasons or tell him how to obtain them. When a decision is based on a credit report, the notice can identify the score used, key factors, and the reporting company. Victor does not translate a denial into, "The system hates me." He writes down the stated reason. If the reason is an inaccurate fact, he returns to the accuracy file. If it is a high balance, he can compare it with the debt plan. If it is insufficient documentation, he knows which proof is missing. If he believes illegal discrimination occurred, he can use the notice, preserve records, and seek help through the appropriate consumer protection channel. Step 5 is written comparison. The CFPB notes that different lenders may use different scores and that shopping around can matter. Victor compares annual percentage rate, fees, total borrowing cost, payment, term, collateral requirements, and prepayment rules. He does not compare monthly payment alone. He does not assume the first offer represents every possible offer. Shopping does not guarantee approval or a lower price. It prevents one visible offer from becoming the entire market. After the card reaches zero, Victor can give the $500 payment a new job. Suppose he begins at approximately age 47 and contributes $500 a month for 20 years. At 5% annually, compounded monthly, the illustration reaches about $205,517. At 7%, it reaches about $260,463. Those are not forecasts. They assume uninterrupted contributions and stable returns before fees and taxes. Real investments fluctuate, and Victor could finish above or below either illustration. Investor.gov's calculator asks for a monthly contribution, time, and estimated interest rate. Estimated is the controlling word. The Social Security Administration says full retirement age is 67 for people born in 1960 or later. Age 67 is a planning marker, not a promise that Victor must stop working or claim benefits then. Pressure becomes analysis when Victor separates three different problems. Wrong report data needs evidence and a dispute. High revolving debt needs a protected reserve and principal payments. Fragmented self-employment income needs organized records. Analysis becomes relief when each problem receives the correct file. The accuracy file makes factual errors challengeable. The debt file makes the balance and assumptions visible. The proof file makes business income and expenses auditable. The decision file turns a denial into specific reasons and comparable terms. If you are between 38 and 52, write down 5 items: your retirement balance, your highest annual percentage rate and the balance charged at that rate, the cash reserve you would keep before an extra payment, the last date you checked all 3 credit reports, and the documents that prove your income and major expenses. Do not try to look wealthy. Make the correct facts visible. Victor began at age 46 with 0 retirement savings, $7,200 of car debt, and 21 years of retirement pressure. The 12-month model does not make him rich. It removes the card balance, preserves a starter reserve, and gives the next $500 a written job. The financial file is still not the whole person. It is no longer an unexamined version of him. That is how Victor stops paying the visibility tax.